After elaborating on the theory, let's consider a simplified example of fund transfer pricing involving three main divisions within a bank, namely lending, deposit, and treasury. What are the assumptions? The deposit division gathers funds through deposits from depositors. The lending division provides loans to customers or borrowers. The loan rate is the interest rate charged on those. The treasury or funding division facilitates these deposits. That means it lends them to the lending division internally. Furthermore, the treasury division engages in funding from the interbank market, as well as the federal funds might be drawn from the central bank to meet, for example, liquidity shortages. Moreover, it might invest in secure assets like treasury bonds for steady returns and diversification on the asset side of the balance sheet. This would be the investment rate. For the sake of simplifying this example, these kind of treasury activities are not being reflected going forward. Let's put concrete figures to our example. By doing so, we will refer in parallel to the transfer pricing rate, or so-called FTP rate. This is the actual rate at which funds are transferred between business units internally. As we will see, it depends on the cost of funds, the respective risk profile, and of course the maturity, both on funding and lending side. Alright then. Let's assume the following. The deposit division accepts customer deposits and pays an interest rate of 0.5% on a term deposit of 2 years. The treasury division credits those with a 2% term deposit rate, the actual FTP rate on the FTP curve, for a maturity of 2 years. The treasury division lends subsequently funds to the lending division at the FTP rate of 3%. And the lending division extends, for example, loans of 30 years to a customer at a loan rate of 4%. These operations foster the complexity of the FTP curve. However, for the sake of keeping the example simple, a normal shaped or logarithmic trajectory of the FTP rate was assumed. This reflects a yield curve during normal economic times where no inversion has taken place, for example, induced by heavy increases of the interest rate carried out by the central banks on the shorter end of the curve. As we can see, the net interest margin is a key metric that reflects the difference between the interest income earned on interest earning assets and the interest expense incurred on interest-bearing liabilities, whereas the net interest margin for deposits is 1.5% and the net interest margin for the treasury and lending divisions are 1% respectively. These figures entail a total NIM of 3.5%. Complementary to the NII calculation, the net interest margin calculation would look as following. For the lending division, this would be interest income is loan amount times the loan rate, or 1 million times 4%, which is $40,000. The interest expense is loan amount times FTP rate, or 1 million times 3%, which is $30,000. And hence net interest income is interest income minus interest expense, which is $10,000. Same goes for the deposit division. Interest income is deposit amount times the FTP rate, or $1 million times 2%, which is $20,000, minus interest expense, which is deposit amount times the deposit rate, which is 1 million times 0.5, and accordingly this is $5,000, and hence the net interest income is $15,000 if we look at the difference between those two amounts. Let's take also a quick look at the treasury spread. $1 million times 1% is $10,000 for facilitating funds from the deposit division to the lending division, plus the skipped part, actually the treasury investments in government bonds and the funding costs from other sources than deposits. So for example, the interbank borrowing rate. We did not put any figures to that, but please bear in mind that this also plays a role in the calculation of the Treasury spread. This simplified example illustrates how FTP can be used to allocate funding costs internally within a bank, ensuring that each business unit understands the cost of funds and can make informed decisions about its operations. Keep in mind that in real-world scenarios, FTP involves more complexities, such as considering all kind of maturity and risk profiles of funds, and that may involve the use of sophisticated models and the respective systems for accurate pricing.